Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow with our third quarter call. And just a few themes that we'll be talking about is that, economy, it's so-so, it's getting by. We see the softness in housing, employment, really in the freight side too as well. And then you've noticed interest rates are lower on the short term, not so much on the long term. And really what we've had in this third quarter is a continuation of the stock market of the second quarter. And so that's changed some things. And then if you look, market concentration is now really exploded. It's the highest that we've ever seen it, really. We'll talk about that a little later. But if you get into the economy, just look at non-farm payrolls. You'll see they've been weak. We had a number come out today from ADP that was negative. I don't know if we'll get anything Friday because of the shutdown. But obviously it's been a continuing decline. And the next thing we've seen is consumer sentiment at really lows that you normally see during a recession. And you have to remember, we have this bifurcated look here where the people that have a lot of money are the top 10% of things. They feel great because the markets are up, they can spend, et cetera, et cetera. But there's a whole group out there that are not feeling the same thing. The other side of it, if you look at all the public trucking companies' prices, they've been under pressure. If you look at the Cass Freight Index, it's been declining. Business has been tough for a lot of the freight companies, and that's usually an indicator a little bit of where this economy is going. But you ask, well, why does it stay up where it is? And this is our opinion, is that if you take the top 10% of income distribution in the country, and all those people own stocks, okay, and stock market's all-time high, they're spending 50% of all consumer spending. And that leaves a big gap between that group and the other 90%, and especially if you take it from the top 25 to the bottom 75. So that's why you're seeing continual spending in some of these areas. The other thing that really sort of bothers us, because if you look at housing, it is a main driver in the U.S. economy. And I think people are in a state of denial because it continues to really get worse. If you look at existing home sales, this goes back 25 years, and they're going nowhere. Not getting anywhere. And the other side of it, I put this in there because if you look at sort of the denial people are in, if you look at list prices per square foot, they keep on raising them instead of going the other way. And of course, some of the selling prices are a little less than the asking price per square foot. But we think somewhere in there, you have to have a change come into play where either people say, look, I can't pay that much, or the prices come off, and maybe they just stay stagnant for a long period of time. But it's a big piece of the economy, so we need to look out for it. The other thing that goes on, you hear a lot about, you've heard about tariffs, things that are going on. I wanted to bring something, though, to your attention. They're always talking about pressing China. In the year 2000, the U.S. as a trade partner is in the blue, if you'll notice. That's where we were more dominant. Look at 2024, though, the red. China is dominant. So if you take India, China, Russia, even North Korea, some of the South American countries, and we feel like we can bully those countries into doing what we want, I think we need to rethink some of that to a degree because it won't be as easy as it looks. And if you look at China, they continue to move forward to try to do more business cheaper and better. I'm not saying that's going to happen necessarily, but I'm saying it's a pretty big machine to try to run over. So if you move on to bonds or interest rates, and I'll talk about the interest rate curve here in just a second, but you need to keep this in mind. This administration is dead set, evidently, on stacking the Federal Reserve Board so that by this time next year, you will have a board that really is pressing rates lower and lower and lower. They don't seem to have a lot of thought process about what inflation might do, which really reminds us of the 70s, sort of the Arthur Burns years. But you'll notice right here, for example, where the rates were on January 1 of this year. That's the green line from 3 months out to 30-year yields. And the red line, the red arrow is about 18 months. So those rate, they can control that rate. What they can't control is the circle. That's the 30-year rate. And what the 30-year buyers are saying to them is that, hey, we don't agree with you. We don't think you can hold that line on inflation. We have to see if it comes out that way, but that's where we are right now. And the other thing that's happening with all of this, if you'll notice the single line at the top of this, is that foreign central banks are holding less and less and less of U.S. debt, U.S. Treasury securities, and buying more and more, bottom line, gold. We don't see that changing really. We don't think they have really confidence in the dollar or this government. And if you'll notice, when you talk about reserves, that's where, when you're in trade situation, currency reserves used to be, a lot of them used to be held in the dollar, and they didn't have any problem. But now you're starting to see, and we haven't been able to track this for a long period of time, it's more of a short-term phenomenon. But if you look at what's happening though, is that gold is becoming more of a reserve holding versus U.S. Treasuries. And we thought that all along for the last 2 years. You look in our portfolios, particularly the high income portfolio, we have miners, we have gold, we have silver, and we really feel like that'll continue going forward. In the stock side, you'll see these two magazine covers when you read our market letter, which will be out just in a couple of days. But the right-hand side is just 2 weeks ago, economists was talking about the $3 trillion bet on AI, artificial intelligence. In 1999, September, same month, that was the GetRich.com once upon a time. It just goes to show you, when you do this build out where people get this idea that you can't lose on something, they spend and spend and spend and spend capital expenditures. And so what's happening right now, and this started with Oracle, they've just come out and have to raise money on the debt side, but all of these companies are having to raise debt now. And they spend a lot of their cash, and they're making huge bets on AI. Whether it works out or not, I don't know, but that's the same thing that happened with telecom and media and fiber back in '99. I'll show you about that in just a second. But right now, what that's caused is 43% of the S&P 500 is concentrated in 10 companies. 10. So that means if you own the S&P 500, you're really not very diversified, because half of that is in these 10 companies, which in many cases are very overpriced. And if you'll notice this, and I'm going to give you something to compare it to, we have what we call TMT. That was tech, telecom, media, but tech, media, and telecom back in 1999. And you'll see they got up to about 44, 45% of the market cap. And they gave it all the way back down to about 11 or 12% and spent years trying to pull out of that hole. And what's happening too is, I don't think people notice this, they look up, and so they got a 60-40 portfolio. A lot of the investment managers and Wall Street keep saying, just set this up like this and you'll be fine forever. And maybe in the short run, the rates come off a little bit, that may work a little bit, but in the last 3 years it hasn't worked. We don't think that's going to be what you want to do in the next decade. But what we do think you need to consider in your portfolios is that this is a graph of a commodity index, but it's in relationship to the S&P 500, meaning that you can see how long it's underperformed. That red line is normal. So if anything at all, what we should see over the course of the next 5 to 10 years is a situation where you see more and more commodities pick up the pace. I think people don't realize that, and so they tend to just have the same old things in those portfolios. I think it'll be hard for them to make the adjustment once it comes. And we're seeing some interesting things. For example, I don't know that it's going to happen, but silver is very, very close to, to basically a 50-year breakout in price above that old $50 price. And a lot of people think, and we own silver, we own gold, we own the miners in the high income accounts, we own some of the royalty companies in our long-term growth accounts. But we'll see if that works that way. But I think you have to keep that in mind going forward. Just some of the recent additions we've had. You'll notice in the stock additions at the top, Gildan, Monster, Regeneron, Union Pacific, you try to diversify away from those big 10 stocks. We own a few of those and some of them. I'm not saying we don't own any of them, but you try to diversify away from that. And I'll give you an example. During April, for example, those stocks that we own like that didn't give up very much at all on the sell-off in April relative to what those big tech stocks did. It was a total change. And then down on the high income side, you know, we just added Hecla Mining, the largest silver miner in Canada and the United States. But we've got, you know, we added Bristol Myers as an income item. And few of the old standbys, we have Matador, Northern, Energy Transfer, all great cash flow items. So we continue to do that as far as that goes. So in summary, what we would say to you is if you look at the kind of the landscape for interest rates, if they fall a lot in the next 6 to 9 months, we really would recommend you using that to get out of your long-term bonds, anything beyond 15 years, 15, 20, 30-year bonds. The other thing that you could look at and really try to do in this period is diversify your holdings away from those top 10 stocks that are all driven by this AI craze. It's all the same stuff. But try to diversify away from that a little bit. It'll make a change for you. And then continue to maintain a cash buffer. Again, we've said all along, you have to have an option to do things if things turn on you. And by holding short-term treasuries, you do have a chance to do some things like that. And the last thing is try not to get caught up in the madness. There really, right now, there's as much madness in the stock market as I've ever seen. And it goes all the way from all sorts of twists and turns on crypto, all the way up to non-earning companies. But just a case in point, UBS has a basket of unprofitable companies that just since July is up 22%. Nobody makes any money, okay? And that compares to only up 2.5% of companies that are profitable. So the madness continues and people keep throwing the dice. They keep making the bet. They keep being short term. And that's okay when things are good. It's like 1999. But eventually you'll get in a situation where people will have to look at things for what they really value in terms of investment. So keep that in mind as you go forward. I hope you get something from what we've done today. If you want more information, though, come to oxbowadvisors.com. And until next quarter, we'll see you. Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.